Okay, so today we're going to be taking a look at the issue of risk management and then different types of insurance. So, the first thing to understand is that there are some things that are just considered pure risk. And what this basically means is that there's no chance that you're actually going to do well as a result of it. So, it's bad stuff that happens to people. It generally happens to be random, and there's always going to be a result in a loss. So, you lose your limb, um, you get an illness, you have active nature, like a hurricane comes through that results into damage to your property. That's considered pure risk. There's nothing that's going to happen that's going to make life better. It's, in other words, it's only going to be loss. Then there's things like speculative risk, and it's a risk where you might do well, you might not do well. Gambling is a great example of something like that, and actually, it's not a thing that you can insure against. Then there's different types of risk. There's economic risk, and then there's different kinds of insurable risks. So an economic risk is happening because of something happening in the economy, like the overarching economy is doing well or doing poorly. There's a risk that's involved in that you might not do well. You might lose your job, but it's not because of something other than just structural things that are happening in the economy, somewhat beyond your control. And when we think about risks, we also sometimes want to insure against them. So some things we can insure against. Insurance basically is a method of spreading out the risk over a large group of people to make losses affordable for all. So everyone pays in. Some people end up having to take out because of a risk that actually comes to fruition, but others don't. Like health insurance is an example of that. Everyone pays in, but not everyone's getting sick at the same time. An insurable risk then is a pure risk that is faced by a large number of people and for which the amount of loss can be predicted to a certain extent. To purchase insurance, then you have to have something that you are trying to protect. So then that is called an insurable interest. It's any financial interest in life or property where the loss would lead to something of you suffering. You'd have damages of some type. And so, therefore, there's three kinds of risks: personal, property, and liability. So, a personal risk is a thing that you're trying to insure against that happens involving something that would ruin your income or your standard of living. A property risk is something that happens, harm to you, personal or real property is called property risk. So, you lose your car, your house gets damaged by fire. That's considered to be property risk. Liability risk then is the chance of loss that may occur when errors or actions the result of injuries of others. So you walk into a store and you fall, or you accidentally cause an injury or damage to another person while driving your car. That's a really common one. A person could fall on your home's crumbling front steps. Like those are types of things that are an error that you made. You should have been driving more carefully. You should have made sure that you did the proper repairs on your home, but you didn't, and someone got hurt. That's considered a liability risk. So, why do this? Why have insurance? The idea here is that there's always risks out there, and there's something that can happen to you, and you can lose a lot of money. The purpose of it is somewhat like gambling. You're basically betting in a way when you're making the payments to the insurance company that at some point you might encounter this risk. And the chance of that taking place is high. So therefore, you're protecting yourself by making these payments. And you think that your payments are going to be less than what would happen when and if you encounter that risk. So you keep paying a little bit each month so that on the off chance that some big thing happens, you've got some money to pay for it. And they're making a gamble on you. Like the gamble is that most people don't run into a lot of these risks. So every single month they're taking in these payments, and hopefully their payments will be more than what the amount they'll have to pay out. So the idea here is we're spreading out the risk. Think of it like a bagel, and you're in the cream cheese. You're putting it on it, so every little part of it gets a little section of it. You're spreading it out. So buying insurance means joining a risk-sharing group by purchasing a written insurance contract, which is considered the policy. And then the insurance company agrees to assume that risk based on that policy, and you pay a fee. And the fee is called a premium, usually paid every single month. Sometimes you can get some deals where you pay it for the entire year and it will reduce the amount of money that you'd have to pay. But commonly you're going to pay it over the month. And the insurance companies assume that only a few policyholders are going to have to pull out of that. It's the idea of insurance is this isn't supposed to enrich you. And if that was the way in which you were going about insurance, you might have committed fraud. Like if you decided that you were going to buy insurance on your home and then burn it to the ground, if they find out, that's going to be considered fraud. It's not supposed to be something you buy and then all of a sudden you gain. Indemnification means putting the policyholder back in the same policy condition he or she was in before the loss occurred. So that's really what you're trying to do, is to indemnify yourself, not to make yourself richer, but like if your house burned down and you put a new house up, it's going to be of the same quality as it was before. So what sometimes you can do is you can buy insurance, but the other thing you can kind of do is manage your risk. And so it's a way of controlling for things that are out there that you might insure yourself against. You maybe can't eliminate risk, but you can avoid danger. Like, wear a helmet when you're driving a motorcycle. That would be a way to manage your risk. So one thing you could do is do what we call risk assessment. It's just looking at all the risk and think about what you can do. You identify the risks, assess the seriousness of it, and then you handle them. Like I said, you look at the issue of driving a bicycle. Well, there's a chance that you might fall and injure yourself. So there's things that you could wear that help protect yourself against that. Risk shifting, sometimes called a risk transfer, occurs when you buy insurance to cover the financial losses that could potentially take place. So, helmet's not enough. You might need to get an insurance policy, and you pay premiums. Basically, you're shifting the risk of major financial loss to the insurance company. Another thing you could do is just not do it. Like if you feel like you're going to be, it's going to be too dangerous to ride a motorcycle, then just don't. You just don't buy a motorcycle. You avoid the activity. Bungee jumping, not for you. You're worried about the potential risks involved, then you don't go bungee jumping. You can reduce your risk by taking some measures of safety. So, you're worried about your car. You put in the winter, you could put on snow tires to protect yourself, wearing seatbelts, helmets. Risk assumption is just this idea that sometimes there's risks out there and you just accept the risk. It's not really recommended for a serious risk, but some things you take a calculated risk. You assume that it's going to take place. You don't buy insurance for it. You just know that it could potentially happen, and you're just going to have to protect yourself against it. Hopefully, you'll have enough money to cover it. Insurance. So insurance, of course, costs money. One of the elements of this cost is the deductible. You pay premiums every single month, but sometimes they have, when you have to do a payout because you're filing a claim, that there's a deductible of some type. So if your car gets damaged, you might have to, like in the scenario here, if your trunk, not your trunk here, the hood of your car gets crumpled in, the cost of it might actually be $5,000. You pay $500. So there's deductibles it's all in the policy that you're going to create. How much of a deductible? Everything thereafter, they'll pay for. Other options, you can look for discounts. You could bundle your insurance. So your car, your house, your home, could all be put into one insurance product. And therefore, by bundling it, you're going to save some money. So now we'll take a look at the different kinds of insurance, property and liability insurance, and then we'll get into automobile. So not every loss can actually be covered by property insurance. There are some things that are put in the policy, as you see here, that aren't covered by it. Usually, sometimes things that we call acts of nature that aren't considered a part of it, or things that are so catastrophic that the insurance company has decided that it's just not going to insure against those types of things. But all policies for renters and homeowners, for example, have exclusions. That's what we're calling that. Things that are not covered. So there's different kinds of policies that you can take out, and probably early on in your life, you're going to rent first. So in order to do that, you actually have a renter's policy. It excludes the property itself because the building itself is not your responsibility. That's the person who is the landlord. They hold insurance for that. But you're going to hold insurance for all the things inside, right? The personal property, the furniture, the clothing, or someone coming to your place and them getting injured. That's all covered by your renter's policy. So even though you don't own the home, you still should take out a policy, and it would be a renter's policy. If you own it, then you take out homeowner's policy. That covers all the things that we talked about, plus the property itself. And it's protecting you against a hazard that could happen, crimes that could take place, like someone stealing something from you, or liability that could happen. And the most complete kind of policy there is called comprehensive. One of the things you might want to do, so that, let's say someone comes into your house and steals things, you have some sort of household inventory. So that way you know the value of all the things in your home. So it's your job to do that. And what their job is to do is to give you replacement value. So it's not to make it so that you get rich again, it's indemnifying you. The cost of the replacement value is the cost of replacing that item, regardless of its actual cash value. So what could what would it cost for you to make it, to get it back? Like if you had jewelry, what would the cost of that be if you had to go purchase it again? Usually you cover contents for half of the value of your home. Home worth 200,000, the contents coverage then becomes 100,000. That's a rule of thumb. But you can change it. But that's the typical way the policies get run. Then you have things that will protect your physical damage that may occur to your home, like an act of nature that takes place. The main component of insurance is to protect financial losses due to destruction of that particular home. You can also get insurance that will help prevent or protect against the possibilities of theft and vandalism. And then liability coverage is like liability we talked about before. Someone comes to your house, they use your trampoline, and they get hurt, which is actually a very difficult thing. A pool or a trampoline on your property is what we consider an attractive nuisance. And so there's usually requirements that you put fences around them so you don't, like, and tell people basically, if you don't have a fence and you have a trampoline, they're saying that what you're doing is you're telegraphing, come to my house, go on my dangerous item, jump on it, and get hurt. So, what you really should be doing is trying to indicate to people that it's not for you to go in, and a fence can do that. Some towns even require you to put a fence around a pool because of that potential liability that's involved. The liability coverage that you get, believe it or not, is supposed to protect you against what we call uninvited guests. So, the typical example is someone doing door-to-door salesman, the post office person, but also you have to protect yourself against someone who's trying to steal from you, and the liability that they could trip and fall there. You're responsible for that. So now we'll talk about automobile insurance. The idea here is to protect yourself against the damage that can happen to the vehicle, the owner, and any passengers involved, and any of the costs of repairs to other vehicles that could take place, and in particular, the medical expenses of other occupants in your vehicle, the other vehicle, and then any kind of property damage that happens to your car itself. And the standard policies also cover theft of the vehicle and its contents. Um, the cost of the automobile insurance premiums are based on lots of different things: the model, the style, and the age of that car. So, sports cars more expensive, older cars might become more expensive. Um, Driver classification. So, what are you using it? Are you, where depends on the state, the type of vehicle you can drive. Maybe it's a motorcycle, maybe it's a car, maybe it's a recreational vehicle, all different types of things that come with that. The location of the driver. Like if you're in an area that has a lot of accidents that take place, then you might end up getting a higher premium that you have to pay. The distance. So if you are going to work every single day, that's going to be one rate. And the farther out you go, the higher that rate's going to be, like the distance between your home and where your place of work is. But if you work from home, maybe you can get a lower rate. The purpose of your driving. Did you just get a car that you're just going to have fun on the weekends, but you're not necessarily going to use every single day? Then that's probably going to be less. And your age, sex, and marital status often sometimes play a part of that. Your driving record also will be a part of this. So how many traffic tickets you have and the infractions that you have, it tells them how much of a risk you're going to be. Your premium's likely to go up in those types of cases. There are five basic types of automobile insurance. We'll go through the first one: liability, property coverage. Liability protects the insured against bodily injury to another person or damage to another person's property. So You get into an accident with someone else. That's liability. You should have been protecting yourself against that by being a good driver. It's usually described as a series of numbers like 100, 350. So the first number is injury of one person. The second number is 300, the number you get for all people that you would get covered. So all the people involved in the accident. And then the last number is property damage per accident. So 100, 350. Most states require drivers to carry liability insurance. Not all states do. New Jersey does. The minimum that we have is 15,000 for injury of one person, 30,000 for of all people, and then 5,000 property damage. But you can get different numbers. And what you're doing there is you're protecting yourself if you up those numbers against when it goes beyond that. But that's the minimum that you're supposed to have in the state of New Jersey. Then collision. Collision coverage is automobile insurance that protects your own car. That one's protecting the other person, but this one's protecting your own car against damage. So it pays for damage to your car in the event that you're at fault. It's your fault. Or the other's driver's liability insurance does not have to pay. And most collision coverage has a deductible, like $250, $2,000, and then the insurer pays the rest. So you could have a $500 deductible, your hood crumbles in, the damage is $5,000, you pay $500, they pay the rest. Then we have something called comprehensive coverage, and that protects you from damage to your car from causes other than a collision or an accident. So some other typically active nature that takes place. And these things happen, so you might want to think about taking it. Then we get personal injury protection. So this is it's kind of the medical insurance that happens because of an accident in your automobile. Medical, hospital, funeral costs of the insured and his of her family passengers, regardless of fault. So you're going to want to think about that. If the insured is insured as a pedestrian or a bicyclist, this insurance will pay the medical costs. Having a car with airbags, for example, or anti-lock brakes can actually help reduce your PIP costs. Then we run into the problem of uninsured and underinsured coverage. That's when you get into an accident with someone else who doesn't have insurance or their insurance is not really of a great quality. So the other driver's at fault, but they don't have insurance or insurance that doesn't fully cover the costs. Your insurer will pay for your medical costs when they can't. So basically it's set up so that way that doesn't, you're protected against people who did not get insurance, even though they're supposed to. And then there's something called an assigned risk pool that consists of people who are unable to obtain automobile insurance due to the high risk they present. The state assigns these people different insurers in the state. So they're just getting lots of tickets and they're pretty high risk. So there's different insurers and they're obviously going to be a higher amount. No fault insurance is an automobile insurance in which drivers receive reimbursement for their expenses from their insurer, no matter who caused the accident. Now we'll take at the final type of insurance, which is health insurance, probably the most common type of insurance that there is. And the idea is the same here. We're just managing risk by spreading out the risk amongst people who are part of the health insurance plan. So, health insurance overarching is a plan for sharing the risk of high medical costs resulting from injury or illness. Like other forms, it reduces the risk. In exchange for premiums, the insurer promises to pay medical expenses for treatments covered by the policies. So we have what we call different types of policies. The first one's a group insurance. It's the most common type of insurance. It's when all those insured have the same coverage and pay a set premium. This is really like basically if you go to a job and you get insurance from them, that's group insurance typically. Okay. So people are getting the policy and they're all getting the same kind of policy. So the whole employee area is going to get that. Then we have other types of group insurance. Well, one is called COBRA, and this is basically for people who are moving from one job to another. They make sure that they continue their insurance plan. So it's Consolidated Omnibus Budget Reconciliation Act. It doesn't really matter. Everyone refers to it as COBRA. It's a law that allows people who leave from one employer to another to still have insurance up to 18 months typically. Now, pre-existing conditions, the Health Insurance Portability and Accountability Act, or HIPAA, limits the pre-existing conditions that a group plan may exclude. And now, because of the Affordable Care Act, that's even greater. It also makes it illegal for the insurer to deny coverage based on health status, though it does not limit the amount the insurer may pay for the coverage. Double coverage. So let's say you and your spouse, for example, both have coverage. You can do something called coordination of benefits. It's a group insurance provision that specifies how the insurer will cover the cost when more than one policy covers a claim. So, typical example of that would be two people who are taking coverage and they're coordinating their benefits. So, the idea here is that this provision assures that the reimbursement will not ever exceed 100% of the allowable expenses. You can't get 110% back. Some things that you can do in a group policy, one is a flex plan, or sometimes called a Section 125 or a Flex 125 plan. It's an employee benefit program that allows employees to set aside money pre-tax to help pay deductibles, co-payments, and other health expenses during the year that are not covered by insurance. So you can buy Band-Aids. You can have some money that's put into an account and you don't end up having to pay taxes on things that are related to your health but aren't covered. Band-Aids is a great example. Over-the-counter types of things. You can also buy individual policies. So that was a group policy, but you could just, maybe you're self-employed or you don't have a job, but you would like to buy something. Typically, you're buying it on your own and you're going to buy it through the marketplace on healthcare.gov. These plans often have higher premiums because it's not part of your employment benefit. It's rather just something that you're purchasing on your own. There's usually a physical exam involved, and people are typically more high risk in this. So you can get two types of coverage. You can get basic healthcare, or you can get what we call major medical insurance. Basic healthcare includes medical, hospital, and surgical costs, whereas major medical provides protection against the catastrophic expenses. Um, there's a stop loss provision, meaning you'll never pay us over a certain max amount in that calendar year. Um, if you can afford it, basic healthcare insurance will cover more things. Major medical will cover less. It will only cover if you got into something really, really bad. Then there's different types of coverage that you can get. And these things can actually be under group insurance, but it's different types of insurance besides medical. You can get dental and vision. Dental insurance covers basic services outlined in the plan. It usually tells you how many cleanings you can get and how many x-rays you're allowed to get. There's specific things in the plan that you might get. You also have vision as well, which pays for eye exams and sometimes even pays for prescription lenses or contacts up to a certain amount. And usually these plans follow like an 80-10, 80-20 rule. The company pays 80% of the cost and you pay 20. And then finally, there's different types of health plans. There's unmanaged, where you can go to whatever doctor, and then there's managed plans, where it's much more controlled. An unmanaged plan allows for the person to go to any provider that they want to. And deductibles for this can range from 100 to 1,000. Same type of thing as we talked about with a car. If the thing costs $500, then you might only pay 100, or depending on what the thing is, but like there's deductibles involved. And it's usually for a whole family, there's a certain number too. Managed care is sometimes referred to as an HMO. An HMO is a large group plan offering prepaid medical care to its members. You choose a primary doctor, and then they give you referrals to go to other doctors. So your back starts to hurt, you go to your primary doctor, they send you to an orthopedic. You don't go right to the orthopedic, and you can only go to certain doctors. A preferred provider organization, mostly known as a PPO, is a group healthcare, same as before. But this time you band together for health services and set fees. And then you don't have to go to get referrals. You can go straight to the orthopedic. And then a point of service plan gives people more choice of control over medical services provided by combining features of HMOs and PPOs. They're basically a hybrid. Along with this, you can have something called a health savings account. It's a little different than a Flex 125. A health savings account, commonly known as HSA, is used in association with a medical plan that carries a high deductible. So you have a very high deductible, meaning it could be like $5,000, meaning you'll pay everything before $5,000, and everything after you're going to get paid for by the insurance provider. So you could potentially be paying $5,000 every single year. Money then becomes set aside to pay for medical expenses because there's a high deductible. You now have money put into this little card, and the contributions that you put in there are also tax deductible. And the employer sometimes will put a little bit of money in there every single year, and it could stay in there from year to year. So if your employer gave you the option of a health savings account and they put in $2,000 every single year and you don't use the plan for a year, you have $2,000 still in the following year. And then when you retire, you would still have whatever you've accumulated in that account that you have not used. Otherwise, it just becomes it's basically a tax shelter. But in some ways, it's also a retirement vehicle because you can use it and you can not use it while you're getting money in there from your employer if they're doing that, and do pretty well with it. Then there are some plans that come from the government itself. We have Medicare and Medicaid. Care for the elderly and aid to the poor. So Medicare is a government-sponsored health insurance for people over the age of 65. So you get free health insurance. There's restrictions on it, but you get free health insurance. You don't have to pay for it. You don't make any premiums or anything like that. And then you have something called Medicaid. Medicaid is for people that are going to get insurance paid for them by the government, not because of an age restriction, but because of living below the poverty line. So people with low incomes and limited resources could potentially be eligible for this. Finally, we'll talk about life insurance. Basically, a disability and life insurance. So disability insurance is an insurance plan that makes regular payments, usually monthly, to replace income loss when illness or injury prevents them from being able to work. So you get a catastrophic illness, you use your healthcare plan, but then you're not going to be able to work for a long time. So you can take this type of insurance if you think that's possible that could take place. Common types of disability insurance include group disability, where you're going to buy it through your employer, or there's some insurance provisions that you have through the federal government that can protect you, and you don't make any payments towards this. Social Security has disability insurance. So you'd have to be adjudicated as someone who needs to be on disability. Or something that happens at work. Let's say you're walking down the hallway and you are at work and someone throws a trash can at you. That's considered workers' compensation because it happened at work. So that actually is the thing that you're paying into through your paycheck. So is Social Security. And you can receive, but the group disability insurance you're going to have to buy. Social Security and workers' compensation you are paying into, and it's pulling out of your paycheck automatically. You can receive a disability benefit until you retire, if that kind of thing happens. Then you have something called life insurance. Life insurance is basically giving a benefit to the people around you after you die. So your idea here is that you're betting that you're going to die sooner than later, and they're betting that you're going to live longer than when you think. Sort of a sad thing to think about, but it's a way to protect your family against something really catastrophic happening to you, especially if you're a major earner in your home. A group life insurance plan can also be purchased through your employer, or you can get a single policy without a medical examination. Portability here is possible because it means that when you leave your employer, you are able to continue paying the premiums and convert your group policy into just an individual policy. So there's two different types. There's temporary and permanent life insurance. Temporary life insurance, you don't use it forever. You use it for a specific period of time, maybe like from your 50s on or something like that. And then you stop after 20 years. And then you don't have the plan anymore unless you predecease before the plan is over. This is the most common form of life insurance, is term life insurance rather. Term life insurance is a type of life insurance policy that remains in effect for a specified period of time. Permanent life insurance remains in effect for the insured's lifetime and actually builds a cash value. Cash value is the savings accumulated in a permanent life insurance policy that you would receive if you cancel the policy. So you can cancel the policy at some point and then get back that cash value. There's four common types of permanent policies: whole life, limited, universal, or variable. And that's the slideshow. Have a good night. Bye.